I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing the 50% tariff set to be imposed by the United States on select Canadian goods that, if everything goes as announced, will take effect August 19th. That comes amid a S&P TSX Composite index that is closing at record highs earlier this week. Hard to hold those two things in your head at the same time, and working out the why behind it maybe can tell us something useful about what the average Canadian actually owns. My guest today to break this all down is Motley Fool Canada Chief Investment Advisor Ian Butler. Ian, thanks for joining me once again.
Happy to get in the weeds of the Canadian market here, Nick.
Okay, so as I mentioned in the intro, Ian, this new 50% tariff set to land in about 3 weeks. This comes while the index is sitting at all-time highs. For folks watching this at home, probably wondering, hey, has the market stopped paying attention to tariffs? What's going on here? Explain why, what's going on in the market, and maybe why the market isn't out to lunch here.
For sure. And I think that's maybe part of what people are skipping past. So the market isn't ignoring the tariff. The market isn't always right, but it often is. So it's absolutely not ignoring the tariff situation. But I think it's making a much narrower bet than the headline numbers suggest. So you mentioned the word selected, and I think that's the key. Industries named in the recent announcements were automotive, dairy, and alcoholic beverages. And the stated reasons are the provincial bans on American alcohol, our supply managed dairy system, and the integrated auto industry. So that's a list of grievances, really, and far from a blanket rate on everything that Canada sells into the U.S. And not to mention that the North American Free Trade Agreement still stands underneath the continent, really, the economics of the continent. So every round of these tariffs that we're kind of getting used to thus far has carved out compliant goods like this, which is why the average American tariff rate on Canadian goods has stayed among the lowest of any U.S. trading partner, even as the headline numbers have climbed. And then if we turn to the Canadian market, let's look at what the index actually is. Canadian market is financials, energy, and materials, which make up 67% of the TSX Composite, and our index is up about 14% so far this year, and which is a gain very largely driven by the big six Canadian banks. The big six account for about 22% of the TSX Composite and have booked an average year-to-date return of 28%. So lots of Canadians own the Canadian banks, and lots of Canadians, I'm sure, are happy with their returns in 2026 so far. Toss in some healthy gains from other heavyweights in the Canadian market, like Enbridge, Canadian Natural Resources, and even the two rail companies, CP and CN. And none of these really are impacted by the tariff headlines. Now, that might raise an eyebrow. CP and CN, of course, cross the border, but their businesses are just so diversified that they are more than able to escape the risk, the narrow risk, as we've discussed, of what's been announced.
Yeah, so fair to say the headlines are scarier than the actual impacts are to the components of the index, especially when you lay out those financials and energy businesses that are, energy in particular, explicitly excluded from this tariff regime. So if you wanted to isolate in on, the segment of the market that is most impacted, where is the real exposure on the TSX and in Canada to these potential new tariffs?
Yeah, I mean, really, the exposed industries, as we've expressed, barely really even show up in a Canadian portfolio. Dairy is supply managed and largely privately held. Alcohol is provincial retail, government owned largely, except for a couple provinces. And neither one is something that you can really go out and own via public equities. Autos and parts are the real listed exposure. And again, the rails are a second order read through because their volumes are manufactured goods that stop moving. But again, CN and CP move far more than auto parts around North America. So most of the rest of the damage is really fiscal and provincial rather than at a Canadian investor's portfolio level. British Columbia, Quebec, Manitoba, and Nova Scotia carry the heaviest exposure to the retaliation list. And frankly, that's a budget problem for those provinces before it's an earnings problem for any of the publicly traded companies that we might be interested in. So what I think what would tell me that the market is wrong is scope creep. let's call it. Today's bet is that free trade compliant goods stay carved out. If that carve out narrows, the arithmetic changes for every exporter at once, and I don't think that's in the price anywhere. There's also precedent for underestimating any of this, as we are not quite sure what's going to come out of someone's mouth from day to day. So in March of 2025, Ontario put a 25% surcharge on electricity exports and backed down almost immediately when Washington threatened steel and aluminum. Those metal tariffs showed up months later anyway, and blinking really didn't buy anything. So watch how this develops. Watch negotiations between the two countries, and don't necessarily be shaken by headline risk. Our prime minister has said that the two sides agreed to intensify discussions and that he'll only sign a deal that works for Canadians, which is another way of saying no deal is still a potential outcome. So we'll see. Really, as it stands, this is a media-driven event, and I think the market has it right to have shrugged off these recent developments.
Yeah, so I think it's worth saying these tariffs are important. They're important for Canada, but as an investor managing your portfolio over the long term, probably best to stick to your knitting, follow the strategy you've been following for years. All right, that's all the time we have for this edition of the 5 Minute Major. Reminder, if you want more stock ideas from us, click on the icon in the upper right of your video screen. Hope you enjoyed this video, and we hope to see you next time. Full on.